Welcome to Buying a Business 101, Valuation, Financing, and Making It Happen. My name is Stephanie Snyder, and along with my colleague Keith Payne, we represent True North Business Funding. Our mission is to help fuel your vision and finance your future by guiding you through the entire acquisition financing process from beginning to end. Today, we're going to walk through four main topics. First, we'll look at how businesses are valued. Next, we'll cover the different sources of capital available to buyers. Then we'll compare SBA financing with seller financing. And lastly, we'll discuss what it means to work with True North Business Funding and how our team will support you from beginning to end. When valuing a business, most Main Street companies are assessed using seller's discretionary earnings, or SDE for short. Larger companies, or those with revenues more than $5 million, are typically valued using EBITDA, which is earnings before interest, taxes, depreciation, and amortization. However, for most small businesses, the SDE will paint the truest picture of earning power. The SDE will start with your net income, but we know that net income never truly tells the full story because most business owners will structure their taxes in order to minimize taxable income. From there, we will add back non-cash items like depreciation and amortization. After that, we'll add back some interest expense and the owner's W-2 salary. Following that, we add back any discretionary benefits or one-time or non-recurring expenses. Keep in mind when adding back the owner's W-2 salary that you're not adding back any sort of draws or distributions associated with that. Draws and distributions will hit the balance sheet and not the P&L, which is very important that those are not added back. These add backs reveal the total cash flow available for a full-time owner-operator. So in other words, the SDE represents the real economic value of the business to you, the new owner. So now let's take a look at an SDE spreadsheet. Here's an example of a typical SDE worksheet. This is what brokers and lenders will use to break down income statements and tax returns and to identify any sort of valid add-backs. The goal here is to normalize the financials so buyers like yourself and lenders can truly understand historical financial performance and cash flow. This SDE here is an analysis of what ultimately informs the valuation and the debt service calculations. On the example on your screen, you'll see lines 1 through 6 are directly derived from the financial statements and tax returns. Line 1 starting with sales and line 6 being the net income. From the net income, you'll add back anything discretionary, one-time, non-recurring, and personal. This includes interest, depreciation, amortization, and owner's salary. And then from there, anything else that the seller deems as discretionary. On line 26, you'll identify your SDE or your seller's discretionary earnings. The SDE has three financial responsibilities. First and foremost, it needs to pay your salary, the new owner. Lenders generally prefer to see at least $75,000 to $100,000 allocated to the new owner's compensation in most Main Street deals. Secondly, the SDE must be able to service the debt, meaning the business generates enough cash flow to comfortably support loan payments and pay those loan payments on time. Third, and last but not least, the SDE needs to provide a cushion, and this cushion covers working capital needs, capital expenditures, and any sort of ongoing reinvestments back into the business. These three key elements here form the foundation of lender underwriting and deal viability. To determine valuation, brokers rely on a combination of quantitative and qualitative factors to determine a multiplier to apply to the SDE. Quantitatively, they'll look at comparable sales, or comps, across similar industries, revenue ranges, SDE levels, and margin profiles. Qualitatively, they examine things like barriers to entry, company history, customer concentration, and the strength of the management team. These factors together inform the multiple applied to the SDE, ultimately driving the business's market value. Will rise or fall based on two categories, growth and risk. Growth factors that push multiples higher include being in a growing industry, having a strong brand recognition, intellectual property, consistent revenue, low customer concentration, and a management team already in place. Risk factors, however, will decrease multiples. These include inconsistent revenue, high owner dependency, low barriers to entry, few assets, a mature or declining industry, or significant customer concentration. Lenders typically will have difficulties lending on opportunities where one customer is more than 20% of the total revenue. This is because if that customer were to leave after you acquire the business, you would effectively lose at least 20% of your revenue. So keep in mind that every business will sit somewhere on this balance of risk and growth, and that the multiple of SDE will reflect that positioning. Buyers typically fund acquisitions through a combination of several sources, first and foremost being cash. Cash is king, and lenders will typically prefer the buyer has a majority of their liquidity tied up in cash. Home equity, such as a HELOC or home equity loan. One thing to note here is that lenders, especially SBA lenders, are a little leery of HELOCs and home equity loans just because it's opening you up to more debt. Securities are another option, including portfolio loans. Retirement funds are a popular option, often through creating a ROBS plan. Next, we have bank financing, including SBA and conventional loans. And lastly, seller financing. Each of these options has different benefits, requirements, risk considerations, but most transactions will involve a mix of these capital sources. This slide outlines the four main financing structures typically used in acquisitions. SBA loans, or Small Business Administration loans, are government-backed, which offer longer terms and can require up to 20% buyer equity injection, although 10% down payment is very standard too. The bank, on the other hand, will finance the remaining portion, and the seller will often provide around a 10% subordinated note. The SBA loan includes fees such as the guaranteed fee and legal costs. Seller financing, on the other hand, involves no outside bank. Buyer here will commonly contribute 30 to 50% down, while the seller finances the rest, usually resulting in more flexible terms, but requiring significant buyer equity. Keep in mind here there are no bank fees, but there will naturally be legal costs in closing the transaction. A conventional loan will come from a bank without SBA involvement. This will typically require between 20 to 50% down, with 30% being most frequently seen on our end. Here you'll see shorter amortization terms and lower interest rates. Seller participation is still common, but certainly negotiable. And lastly, an earnout, which is certainly not very common, but they tie part of the seller's payout to future performance metrics. This is used strategically, especially in assessing current performance from a buyer, but this is not an eligible financing method to be used in tandem with SBA financing. So understanding these structures helps you, the buyer, choose the most strategic and cost-effective path to closing and moving forward. At True North Business Funding, we bridge the gap between exploring financing options and successfully closing your acquisition. We begin by providing a financing estimate before you even submit an offer. This will give you clarity on affordability, funding structures, and lender expectations. We then will connect you with top preferred lenders, allowing multiple institutions to compete for your business and enabling you to choose the most attractive structure. Our team will have also completed a comprehensive business analysis, ensuring that the business meets debt service requirements. With open communication, we keep all parties aligned, the buyer, the lender, and the broker. This in turn reduces friction and surprises. The result is a smoother, faster closing backed by a strategic advisory team guiding you throughout the entire way. Choosing not to work with a financing advisory partner introduces several risks. Without a financing estimate, buyers may submit offers without knowing whether they qualify, creating uncertainty and jeopardizing negotiations. Without demonstrated financial readiness, sellers may view you as a less serious buyer, weakening your negotiating power. Limited access to preferred lenders can result in higher interest rates or less favorable terms. A lack of coordinated financing strategies lead to delays, miscommunication, and added stress during closing. And finally, slower financing results in extended due diligence periods, which can put the entire transaction at risk. Time kills deals, and our goal is to remove these obstacles before they even arise. All right, now let's recap. Business valuations are based on multiples of SDE. This is influenced by both quantitative data and qualitative business characteristics. Capital sources can vary widely, from cash and home equity to portfolio loans, ROBS plans, seller financing, and bank financing. Each carry different requirements and risk levels. Financing methods each carry different equity requirements and lender or seller participation levels, and choosing the right structure materially will impact your success. And finally, True North Business Funding provides financing estimates, lender introductions, debt service analyses, and advisory support to streamline your path to closing. Thank you so much for joining this presentation. If you have any questions or would like a financing estimate, please reach out to our team at team@tnbfunding.com. We look forward to helping you and wish you the best of luck on your acquisition. Thank you.